Kevin, I know you did a recent study of a little bit more than 100 companies. You found that B2B companies outperformed B2C companies post-IPO. Out of curiosity, how long did you do the study for? 100 companies over what length of time?
So Deirdre, first of all, it's great to be here. We did do a study that spanned the years 2004 to 2010. We looked at 103 technology IPOs during the course of that time and analyzed their one-year post-IPO performance to see if there were any trends that we could sort of discern from that data.
So what did you find? That B2B companies tend to perform better than B2C. Why is that? Because you look at this data, but you're also drawing conclusions from them.
Absolutely. So first of all, I mean, the actual numbers. Technology IPOs in the business-to-business sector, we found during that period of time tended to perform at about double the rate, so returned about twice what consumer-focused technology companies did in their first year after going public. And as investors exclusively in business-to-business technology at Emergence Capital, we fundamentally believe we know why this is true. We see this even in the private companies we invest in. Technology that is sold to businesses, it's a considered purchase, right? Businesses think about what they're going to buy before they buy it. And then once it's adopted within the organization, it tends to become pervasive and it tends to become part of a business's workflow. So it's very sticky. It's very hard to dislodge once it's in. And furthermore, on the flip side, in the consumer world, there's the exact opposite factor at play. Consumers tend to be fairly fickle when it comes to the technology or the media that they consume, and they're sort of on to the next hot trend once it actually does become hot.
So just based on what we're talking about, if we do a B2B survey, I'm thinking of Salesforce.com as one that's outperformed, SuccessFactors, and then on the flip side, B2C examples such as Facebook, which I think pretty much everybody takes as the way to go public, every single list of what not to do, and Zynga, another one.
Absolutely. Well, again, I think every company, Deirdre, has its own story and reason for its performance or lack of performance. So I don't want to pick on any companies in particular, but certainly, Salesforce, SuccessFactors, those were two companies we were involved with as venture investors. They've performed obviously exceptionally well. SuccessFactors acquired last year by SAP for $3.5 billion. There's another recent example, not one of our portfolio companies, but a company called ServiceNow, also a software as a service company that went public recently, has also performed really well post-IPO. So there are definitely more recent examples, but our period of time, or our study actually covered a period of time that went back much further than just the last couple of years.
Yeah, which is good because, as you say, it takes out the outliers that we've seen this year so far, which have been driven some pretty big headlines and, of course, have had some pretty big numbers, especially in Facebook's case.